I thought I would take advantage of that opportunity. So I'm going to be speaking about Chinese investment in Africa, opportunities, challenges, and future directions. And this, I think, is a nice segue from the morning session. I'm also going to be focusing on manufacturing, because that's what my research is about, my current research, not the book that I've just published. So what I'm going to talk about here is a little bit, first about China's restructuring, and then an overview of Chinese FDI to Africa, the sectoral basis of that, and then the focus on manufacturing, and how will China's slowdown affect this FDI. So first of all, these threats and opportunities. What we can see in this slide here is the changes in the growth rate of trade. So we all know that China's trade with Africa is very large now. Last year it was $222 billion. Some people suggest that this year it's going to be 300. I don't see how that could possibly be true, given the declines in commodity prices and declines in Chinese demand. But nevertheless, the trade in absolute figures is high. But what this suggests is that the growth rate has been, in the previous years, from 2004 to 2008, the average growth rate every year was expanding by 40%. And then it dropped in 2009. It was negative that year. So from 2009 to 2014, the average has gone to about 6%, including that negative year. So that is a much slower growth rate. And I think that means that this is a normalizing relationship. So we don't have those really high levels, and I don't think we're going to go back to that anytime soon, if ever. So this is China's global FDI outflows up through 2014. And as we can see, this is still growing. The 2015 numbers, of course, are not yet out, but we can see a healthy growth rate there. In terms of what is happening in Africa, this has been, again, these are the official Chinese figures, and I'm going to talk briefly about why they're a little bit problematic. But from about 2010 to 2014, this has not been going up in any consistent fashion. It's been a little up and down. And again, this data is not very good, but it is what we have. I'm going back here to China Exim Bank. These are annual disbursements, and this again goes up to 2014. And what's significant here is that if you look at the figure up there, it looks as though it's all getting much, much bigger. But what this data down here suggests is that the export sellers credits, which go to Chinese companies, and the export buyers credits are not going up. They're dipping down now, and what's larger is letters of guarantee, which go out for other financing. So this suggests that Exim Bank may not be expanding. This is not just Africa, of course, but it may not be expanding at the same rate that we've been seeing it in the recent past. So all of these are suggestions that things are cooling down. And right here we've got China's FDI flows to Africa as a percentage of China's global FDI. So the little yellow part at the top represents what's happening with Africa, and it's small. So there's one little bit of a bigger jump here. This, of course, is the year when the ICBC purchased 20% of Standard Bank in South Africa. So it's the only year where it's really been a slightly bigger amount, and everything else is fairly small. So now, the data itself on China's FDI is deeply problematic, and it's problematic for a number of reasons. Most people in the room probably are familiar with these, but one reason is that the Chinese FDI figures are they're coming out from China. They're not measuring FDI that's already outside of China, but it's still Chinese capital and coming into Africa or other parts of the world from Hong Kong or from the British Virgin Islands, Cayman Islands, Mauritius, Switzerland, other offshore financial centers. So that doesn't get captured here. Now, we have these figures here. There was something just a couple of weeks ago from the Financial Times that said, ooh, Chinese FDI to Africa has plunged 84%. If we look at a report that came out, and that was in the first half from 2014 to 2015. Deloitte said in the first half of 2014 to 2015, it's up 360%. And then MOFCOM suggested in terms of the first quarter of 2014, the first quarter of 2015, it's down by 45.9%. So this is a huge variety of figures here. And what these are based on, they're all based on different things. So the first two are based on media reports. And so these are of companies that say they're going to make an investment of a certain nature and how much that investment's likely to be. And then Financial Times database and Deloitte both just put in that expected value. And so that's why these things can vary depending on how robust they think those figures are and whether they even put them in their database at all. But there's this huge variation. Now, this is looking at, again, over time. These are the Chinese official FDI flows. And down here is the China Investment Tracker, which is another database, which is done by Derek Scissors at the American Enterprise Institute in Washington. And again, you can just see the difference here. Derek has in 2013, for all of Africa, $21 billion in investment commitments. And then down to 2014, 5.7. And that's very different from what you see coming out in the official figures from China. So all of this is to say that we haven't a clue, really, what's going on here. But that the figures are large, and they're not going to be as large as the China Investment Tracker suggests, and the dip is not going to be as large as they're suggesting there either. So the problems also come out because people use different kinds of things, and they call them all investment. So, for example, this is from something that a World Bank presentation in Addis Ababa last July, and they looked at the value of Chinese contracts, which actually happens to be infrastructure contracts, and they said this is a proxy for committed investment flows, and it's no such thing. There's no relationship there between Chinese companies that are building infrastructure and then those that are making FDI investments. So that was so $82 billion. Again, this was Chinese contracts based on Derek Scissors, which is just the value of contracts that a Chinese construction company may have in Africa. So it has no relationship to FDI. So there's a lot of lack of understanding of what these different numbers are. So, and here it just shows that these are the official figures for the infrastructure contracts, and in 2013 it was between $45 and $50 billion. So it is quite high, but it's not FDI. This is just a contract. So the sectoral investments, we don't have very good data, but what we do have suggests that there is a lot of investment outside of mining, which is what most people think the Chinese are very actively doing. So we can see in terms of finance, that's again the standard bank investment. Agriculture is not very big, and I can tell you why if you come tonight to my talk. Manufacturing and the construction industry. And this is, the construction industry is companies that have set up and the value of the overseas offices that they have, and then manufacturing. So manufacturing in 2012, the stock was $3.4 billion, according to the official figures. We're not sure, again, how accurate that is. So what we've done in our project is we've looked at the MOFCOM approvals data, how many projects per country have been approved that mention that they want to do production of something. Now this again doesn't say that they're actually going to do this. So we're tracking down from these approvals data, we're going and doing field work and scoping studies to find out how many companies have actually set up factories. But this is what they said they would do. And so this is as of the end of 2014. So you can see Nigeria, Ethiopia, South Africa, these are some of the biggest places where Chinese companies have the intention to set up manufacturing. As we heard earlier, Ethiopia is one of those places, and there is a lot of interest there, and Nigeria is the largest. So we've done scoping studies already in Nigeria, Ethiopia, Ghana, and Tanzania, and we found that the actual investments are a fraction of this. They're not nearly as high as this for many reasons. This is a picture I took in Nigeria, and this actually is not a Chinese investment. This is a Nigerian investment, but he's purchasing his machinery from China, and this is an important avenue which is really kind of underexplored of technology transfer. So it's African manufacturers buying their equipment and then having it set up and the training done by Chinese companies. So we can talk about more of this. The flying geese model is this idea, and Justin Lin has publicized this, I've also written about it, that there are lead manufacturers, and then that as they move out of a sector, those opportunities open up for others, and so the lead goose can change over time. And so I've got this idea in Africa that there are 4 different kinds of Chinese geese coming. It's not all the same kind. So there are the geese seeking raw materials, there are the vertically integrated geese, there are the geese traveling together, and there are the strategic geese that are looking for local markets. So let's look and see what we have there. So the geese that are seeking raw material. In Ethiopia, we can see this in the leather sector, so we can also see it in cotton and textiles. But these are geese that are seeking raw materials. They're looking, because of Ethiopia's industrial policy, it's made it hard to purchase the kind of raw leather that they used to purchase in the past. Now they have to come in and they have to process it. So they are setting up companies to do this. And we can see this also in the cotton industry in Ethiopia, Madagascar, and other parts of Africa, that Chinese companies are buying raw cotton and now setting up some spinning industries in order to process that. So this raw material, we can see it in oil. There's some oil refineries, some copper refineries, and so on. So that does lead to a certain level of manufacturing. Then there's the big vertically integrated goose, and this is in the copper industry. These are all from the non-ferrous metals company in Zambia. I didn't take these pictures, so this is just from their website. But they've got a lot of different activities in terms of refining metals. So you have this vertically integrated company in the special economic zone in Zambia. Almost all the companies are actually subsidiaries of China Non-Ferrous Metals, and they're doing different parts of that value chain. Then there are the geese traveling and settling together. This picture here is of plastic rubbish. I'm not sure if this is in Tanzania or in Ghana. Xiaoyang, my co-author on this particular paper, took that picture. But what is happening is that these, this represents one of the things we found in our study, which is that Chinese entrepreneurs were coming in and they had not originally intended to set up plastic bag manufacturing, but that's what they did. And they're recycling these plastic bags here, and they're turning them into other kinds of plastic products. So it's a recycling business. And the companies have now, there are like 8 to a dozen companies doing this. And some of this technology transfer has shifted over to Ghanaian entrepreneurs as well. So that's one area of technology transfer we've seen. And this is also in terms of geese traveling and settling together. We see in Ethiopia, in the leather sector, there are other companies coming from Asia and settling down in Ethiopia now that Huajian has started. So this is another big George Shoes company that came from China, but it's Taiwanese owned. So in Huajian, as we can see here, and other pictures which you've already seen. And then finally is the strategic goose, the one that's looking at local markets. And what we found from our initial research is that the building materials industry is a huge attraction there. So this is import substitution. A lot of the construction that is being done by all of those companies from China that have all of those contracts that we were reading about earlier, a lot of them have been bringing in their construction materials from China. But this provides a good opportunity for local import substitution of those building materials. So we see in terms of iron pipes, cement, and other kinds of products that go into buildings and infrastructure, there are opportunities that companies are taking up there. In South Africa, we see this as well, that companies are coming in to sell into the region. So they want to set up factories in South Africa and then market into the South African region. So you can see this from FAW Auto Assembly here. And then Ethiopia, this is Lifan. So they're again looking for local opportunities to do import substitution, and Hisense in South Africa. So where do the geese land? Some of the manufacturing is connected to old aid projects. So some of the, and I wrote about this in the Dragon's Gift, but this is from Tanzania. It's an ancient, the Friendship Textile Factory. But there are others like this. Sugar refineries are another example of this manufacturing that are connected to old aid projects. There's a lot of that. So it's not necessarily where the World Bank suggests they ought to go. So if you look at the doing business rankings, the places where the companies are interested in going don't necessarily rank in the best levels of this. And you can compare this with China, which also doesn't rank very well. So this suggests to me that the Chinese companies are looking for something other than what the World Bank says is the best environment. And that's something we could explore further. They're also looking at places where there's a big local market. And so if you look at this, it's the population density and the rank in Africa. So again, these are the top 5 places where Chinese companies want to go to produce things. And these are in terms of the size of the populations in Africa, the 1st, the 2nd, 4th, 5th, and the 7th. So it's big local markets. And then finally, where they have contacts. So this is, they have guanxi there. They already know people through raw material supply or global value chain. So in leather in Ethiopia, it's not just Huajian. It's companies that are not Chinese owned that are coming in there. We see companies coming from Germany, from Italy. I mean, these are Italian companies, German companies, Taiwanese companies, Hong Kong companies owned by these, but they're coming from China. So they are relocating off, but they aren't necessarily Chinese owned. And we saw this also in Mauritius and Madagascar, this cotton value chain with a Chinese spinning company that's been in Mauritius for more than a decade. And now they're setting up some backward linkages in cotton subcontracting in production in Madagascar. And then finally, where they built trust through long-term trading relationships. And this again relates to these the technology transfer, because the work we were doing in Nigeria, we found a lot of companies that were importing this machinery, and this is how the technology was transferred. They didn't actually there wasn't any FDI from China coming in, but there was a lot of skill building, because they would send technicians for a year or longer to train people in how to operate this machinery and how to produce these products. And so that's something that we're also studying through our project. So again, not just Chinese FDI, these skills transfers are coming in through other investors that are of other nationalities, but they're bringing their technical experts from China to come to Africa to teach how to do this. And this is an example from a British-owned factory in Ethiopia that has a Chinese team that teaches the Ethiopian workers how to do this. And then as they learn it, they move up to other products and up the value chain. So that's the end of, it probably went beyond 15 minutes, I apologize.